Hello everyone. Today we're going to be following on our safe assets portfolio. For those of you who've been watching our videos, you'll remember that at the start of the war, around March 2nd, we went ahead and we put our money into what we deemed to be safe assets. And we deemed this to be safe assets because we had a notion that this would be negatively correlated against the S&P 500. So if the S&P 500 drops, these ones would go up in price. And sure enough, that's what we have been seeing. So, as you all may remember, these are all exchange traded funds. And that means that this is a diversified portfolio. And these are the assets that we have invested in. So, if we take a little bit of a closer look on what each one of these has been doing, as you may notice, the S&P 500, the line at the bottom, has been dropping in price. But the assets that are negatively correlated against it, which are the ones that we chose on March 2nd, have been performing well while the S&P 500 drops in price. Now, how does this work when you have the negative correlation? If we see USO, it is the one that is performing the best out of all of them, and that is because due to the shortage in oil supply, the oil futures are becoming more valuable, and that is pushing the price of USO to go up. But that also means that anytime there's any kind of slight bump on the S&P 500, the USO will drop. It is the same thing with all the other ones, except maybe DBA, which is a little bit more impervious to changes and it continues to increase regardless of what the S&P is doing. So that means that when we are choosing these safe assets that are going to perform in a way that is negatively correlated against our benchmark, we have to make sure that we understand that there are certain risks, right? So that means that this safe assets portfolio will continue to perform well while we have the war and while there's shortage in oil. But once all those current situations disappear, which we know they're not going to last forever, these safe assets will probably start to drop and the S&P will go up. So you need to have safeguards on it, right? So trail stops or other items or other tools that will allow for this to stay profitable while we have the current situation ongoing. Another asset that we created was the automated portfolio on March 20th. And this one was something that was very, very, very diversified against the S&P. But as you notice here, sometimes the S&P perform better and sometimes our portfolio perform better. In the end, our portfolio, because it's very well diversified over stocks, large companies, and medium dividend investments, we were able to weather some of the negative returns that have been happening on the S&P. But it's not impervious. As you notice here, there's a few times when the S&P is performing better, and even while this one, our portfolio performs better than the S&P, it still dips when the overall market drops in price. So basically, this means that there are different ways that you can safeguard your assets during turbulent times like there is now. You can either go with assets that are completely negatively correlated against the overall benchmark, which in our case is the S&P 500, or you can diversify with assets that may be correlated to the S&P 500 but will not be as affected because of the things that are happening. So always remember there's different places to put your money, and you want to try to keep your assets safe during turbulent times in order to be able to enjoy the profits while times are calm. Thank you for watching.